Trading the gold-to-silver ratio standard. The gold-to-silver ratio, often shortened to GSR, is one of the oldest relative valuation tools used in financial markets. Long before modern charts, indicators, and algorithmic trading systems existed, traders and investors observed how many ounces of silver it took to buy 1 ounce of gold. That simple relationship has survived centuries, market crashes, monetary regime changes, and technological revolutions. Today, the gold-to-silver ratio standard remains highly relevant for traders looking to identify asymmetric risk-reward opportunities in precious metals. At its core, the gold-to-silver ratio measures relative value rather than absolute price. Instead of asking whether gold or silver is expensive in dollar terms, the ratio asks a more nuanced question. Is gold expensive compared to silver, or is silver expensive compared to gold? For traders who understand how to interpret this relationship, the answer can reveal moments when the probability of a favorable trade is meaningfully skewed in their favor. The gold-to-silver ratio is calculated by dividing the price of gold by the price of silver. If gold is trading at $2,000 per ounce and silver is trading at $25 per ounce, the GSR is 80. That means it takes 50 ounces of silver to purchase 1 ounce of gold. What makes this ratio powerful is its ability to normalize price movements. Gold and silver can both rise or fall at the same time, yet the ratio may still change dramatically. When the ratio rises, gold is outperforming silver. When the ratio falls, silver is outperforming gold. Traders are not just betting on direction, but on relative performance, which opens up strategic possibilities that are often missed by price-only analysis. Over long historical periods, the gold-to-silver ratio has tended to oscillate within broad ranges rather than trend endlessly in one direction. These oscillations are what traders focus on when planning trades. Historically, the gold-to-silver ratio has varied widely depending on monetary systems, industrial demand, and investor sentiment. In ancient civilizations, the ratio was often fixed by governments, sometimes near 12:1 or 15:1. Under bimetallic monetary standards, these fixed ratios were attempts to stabilize trade and pricing. In modern free-floating markets, the ratio is no longer fixed, and that flexibility is precisely what makes it useful to traders. Over the last century, the gold-to-silver ratio has spent significant time between 40 and 80, with periodic extremes well above or below that range. During times of financial stress, the ratio often spikes higher as investors flock to gold's perceived safety while silver, which has a stronger industrial component, lags behind. These extremes are not random. They reflect shifts in fear, liquidity, and economic expectations, which is why many traders view the gold-to-silver ratio as sentiment and macroeconomic indicator, not just a pricing tool. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmentees.com and use the code BLOG to receive 20% off your next purchase. To understand how to use the gold-to-silver ratio effectively, it helps to understand why gold and silver behave differently. Gold is primarily a monetary and store of value asset. Central banks hold it, investors buy it during crises, and its demand is heavily influenced by inflation expectations and currency. Silver, on the other hand, sits at the intersection of monetary metal and industrial commodity confidence. It is used in electronics, solar panels, medical equipment, and numerous industrial processes. This means silver tends to be more volatile and more sensitive to economic growth expectations. When economic uncertainty rises sharply, gold often outperforms silver, pushing the gold-to-silver ratio higher. When growth expectations improve or inflation becomes the dominant concern, silver can outperform gold, driving the ratio lower. Traders who track these dynamics can align their positions with broader macro forces rather than trading in isolation. One of the most important uses of the gold-to-silver ratio standard is relative valuation. Instead of asking, should I buy gold or silver right now? Traders ask, which metal is undervalued relative to the other? When the ratio is historically high, silver is cheap relative to gold. When the ratio is historically low, gold is cheap relative to silver. This does not mean the ratio must immediately reverse, but it does mean the odds begin to favor mean reversion over time. Traders use this insight in different ways. Some rotate capital from gold into silver when the ratio is elevated. Others structure spread trades that go long silver and short gold, seeking to profit from a narrowing ratio regardless of whether prices rise or fall overall. Using the gold to silver ratio strategically requires patience and context. Traders rarely act on a single reading. Instead, they compare current levels to long-term averages, historical extremes, and macroeconomic conditions. When the ratio moves into the upper end of its historical range, traders begin planning for scenarios where silver could outperform gold over the medium to long term. This planning might involve gradually accumulating silver positions or reducing gold exposure rather than making an all-in decision at once. Conversely, when the ratio falls to unusually low levels, traders may prepare for gold to regain relative strength. In this case, the strategy might involve rotating profits from silver into gold or hedging silver exposure. The key idea is that the gold to silver ratio helps traders structure decisions, not predict exact turning points. It frames the market in terms of probability rather than certainty. One of the most compelling reasons traders monitor the gold to silver ratio standard is its ability to highlight asymmetric risk-reward setups. When the ratio reaches extreme levels, the downside risk of betting on mean reversion often becomes smaller relative to the potential upside. For example, if the ratio is already historically high, gold has significantly outperformed silver. At that point, much of the fear-driven demand for gold may already be priced in. If conditions stabilize even slightly, silver can begin to catch up quickly due to its higher volatility. This creates a situation where the potential gain from silver outperforming gold is large, while the risk of further divergence may be more limited. This asymmetry is what attracts experienced traders. They are not predicting the future with certainty, but they are positioning themselves where the payoff justifies the risk. While the gold to silver ratio is not a precise timing tool on its own, it can significantly improve entry and exit decisions when combined with price action and macro context. Traders often wait for confirmation, such as stabilization in the ratio or early signs of reversal, before committing capital. For instance, after a sharp spike in the gold to silver ratio, traders may wait for the ratio to stop making higher highs before increasing silver exposure. This approach reduces the risk of entering too early while still capturing much of the potential move. On the exit side, traders monitor the ratio for signs that relative value has normalized. When the ratio approaches long-term averages or historically low levels, the risk-reward balance shifts, and it may be time to reduce or exit positions. Imagine a period of global uncertainty where gold rallies strongly while silver lags behind. Gold rises to $6,300 per ounce, silver trades at $70 per ounce, and the gold to silver ratio climbs above 90. Historically, this level has been rare and often associated with panic-driven market conditions. A trader analyzing this situation notes that silver is deeply undervalued relative to gold. Instead of trying to predict the exact top in the ratio, the trader begins planning a strategy focused on relative performance. They gradually allocate capital towards silver while maintaining some gold exposure as a hedge. Over the following months, economic conditions stabilize. Industrial demand expectations improve, and silver begins to outperform gold. Gold remains relatively flat, while silver rises to $90 per ounce. The ratio falls from above 90 to around 70. In this scenario, the trader benefits not just from silver's price increase, but from the contraction of the gold-to-silver ratio. The initial decision was not based on guessing prices, but on identifying a skewed risk-reward profile using the GSR standard. In an era of complex derivatives, high-frequency trading, and advanced analytics, it might seem surprising that a simple ratio still holds relevance. Yet the gold-to-silver ratio endures precisely because it captures something fundamental about human behavior, fear, and value perception. Gold and silver are deeply embedded in financial psychology. Their relative performance reflects shifts in confidence, growth expectations, and monetary conditions. The gold-to-silver ratio distills these complex forces into a single, interpretable metric that traders can use to frame decisions. As long as gold and silver remain central to global markets, the gold-to-silver ratio standard will continue to offer insight into when risk-reward dynamics favor one metal over the other. Conclusion: the gold-to-silver ratio is more than a historical curiosity. It is a powerful framework for understanding relative value, market sentiment, and asymmetric opportunity in precious metals trading. By focusing on relationships rather than isolated prices, traders can position themselves where the odds are more favorable and the potential rewards justify the risks. When used thoughtfully, the gold-to-silver ratio standard helps traders plan investment strategies with greater clarity, identify moments when the risk-reward ratio becomes appealing, and avoid emotionally driven decisions. Whether applied to short-term trades or long-term portfolio management, the gold-to-silver ratio remains a timeless tool for those willing to look beyond the surface of price charts and think in terms of relative value and probability. Thank you for watching.